Most people miss thousands of dollars in tax savings every single year. And not because they file late, but because they don't take the right actions before December 31st. And that matters because many tax strategies only work if they are completed before the year ends. And once the year closes, two things happen. Some benefits reset, which means you may get another chance next year, while others disappear entirely. And as a practicing accountant and tax strategist at KeepMost.com, this timing mistake is the most common reason we see people overpay. The reason it happens is pretty straightforward. Most people think filing taxes and planning taxes are the same thing. And because they treat them as interchangeable, they focus on the wrong thing all year long. So in this video, I will give you 5 smart moves so you pay less in taxes. Use this as your year-end tax checklist. And it has to be followed in order because each step changes what's possible in the next one. So let's start with the first method. Step 1 uses a method called tax loss harvesting, and it addresses taxes that may already exist. You see, if you sold investments at a gain this year, you created a capital gains tax liability, and tax loss harvesting allows that liability to be reduced, and in some cases completely eliminated, because capital losses offset capital gains, dollar for dollar. Under normal circumstances, if losses exceed gains, up to $3,000 can offset ordinary income, and remaining losses carry forward indefinitely. But this only works if losses are realized before December 31st, which is why timing matters here. This is one of the most commonly missed strategies we see inside KeepMost, and that's especially true for people who assume that their investments and taxes are separate decisions. So here's how to implement tax loss harvesting. First, review your realized capital gains for the year because you need to know what you're offsetting. Next, identify investments trading below their purchase price because unrealized losses do nothing for your taxes. Then sell enough losing positions to offset the gains you already realized. And this is key. After selling, you want to wait at least 30 days before repurchasing the same or a substantially identical asset, because repurchasing too soon triggers wash sale rules. And if wash sale rules apply, the loss there is disallowed. Now, there is one exception to tax loss harvesting worth separating out here. Cryptocurrency is treated differently under current rules because wash sale rules do not currently apply to crypto. That means a crypto asset can be sold at a loss and then repurchased immediately, and the loss is still allowed. This applies to Bitcoin, Ethereum, and most other cryptocurrencies. Now, the timing still matters because the sale must occur before December 31st. Okay, step number 2 uses pre-tax retirement contributions. And this step shifts from offsetting taxes to reducing taxable income itself, because pre-tax retirement contributions reduce taxable income for the year that they are made because they lower the amount the IRS can tax in the first place. This includes employer 401k contributions and solo contributions for self-employed individuals. So here's how to implement pre-tax retirement contributions. Start by reviewing your year-to-date contributions. If you're employed, increase payroll deferrals if additional contributions are allowed. If you're self-employed, establish a solo 401k before December 31st and complete the required election. Okay, step number 3 uses asset-based charitable giving, and this step affects how gains are taxed. You see, charitable giving can be structured, and the structure determines the tax result. In many cases, donating appreciated assets produce a better outcome than donating cash because it avoids capital gains tax entirely. So when appreciated assets are donated, capital gains tax is avoided. The full market value is deductible, and the charity receives the full asset value. This is most effective in higher income years. At KeepMost.com, this is one of the strategies that often surprises people because the tax benefit comes from how you give and not necessarily how much you give or how generous you are. So here's how to implement asset-based charitable giving. First, identify appreciated assets held in taxable accounts because retirement accounts do not qualify. Next, you want to confirm that the organization receiving the donation is a qualified charity. Then donate that asset directly or contribute them to a donor advised fund. A donor advised fund allows the deduction to be claimed now, while donations are distributed later. But the deduction must be established before December 31st, or that benefit shifts to next year. Okay, step number 4 uses expense acceleration for business owners. And this step applies primarily to cash basis businesses. You see, business owners often control when expenses are paid. And because cash basis accounting deducts expenses when paid, this creates planning flexibility. That flexibility allows certain expenses to be prepaid before year end to reduce current year taxable income. Common examples include software, insurance, rent, and professional services. Here's how to implement expense acceleration. First, you want to estimate year-end net income. Then identify legitimate expenses that can be prepaid. Confirm deductibility, then pay expenses before December 31st and retain documentation. Now, step number 5 includes advanced methods, and these depend on eligibility and not preference. You see, in some states, pass-through entity tax or PTET allows state taxes to be deducted at the entity level, which can bypass federal limits on individual deductions. In addition, certain equipment purchases may qualify for 100% bonus depreciation. This includes vehicles used primarily for business and homes used for business. These are examples of the more advanced strategies that tend to get missed without a structured system, which is why we track eligibility automatically inside KeepMost.com. So here's how to implement PTET and bonus depreciation. First, confirm availability in your state. Verify that your entity qualifies. Next, evaluate planned equipment purchases and confirm business use percentage. Then complete purchases before December 31st because purchases after year end move the deduction to next year. All right, bonus step number 6 is bunching itemized deductions. You see, some taxpayers benefit more from itemizing than taking the standard deduction. Now, bunching involves pulling multiple years of deductions into one year and then taking the standard deduction the following year. But this only works if itemized deductions exceed the standard deduction, which is why calculation comes before execution. Now, this is done automatically inside KeepMost.com, but here's how to implement deduction bunching. First, project total itemized deductions. Next, compare them to the standard deduction. If itemizing is higher, prepay eligible expenses and retain proof of payment. If not, do not use this strategy. All right, bonus step number 7 covers time-sensitive tax advantage accounts. And these benefits expire if unused, including unused flexible spending account balances, certain state level 529 deductions, and the annual gift tax exclusion. Other accounts such as HSAs and IRAs allow later funding but still require planning. So here's how to implement this final step. Review your remaining FSA balances, confirm state rules for 529 deductions, and plan HSA and IRA contributions. And schedule deadline reminders because forgetting is the most common failure point. Now, there is one mistake that undermines all of this, and that's trying to do tax planning during filing season. Most year-end tax strategies, as we see, cannot be implemented after the year ends because timing simply cannot be reversed. To summarize, year-end tax planning is primarily about timing. The methods we covered today were tax loss harvesting, pre-tax retirement contributions, asset-based charitable giving, expense acceleration, bonus depreciation, deduction bunching, and time sensitive tax accounts. And these 7 are just a portion of the 90 plus strategies we analyze in depth at KeepMost. Each method requires action before the calendar year ends because once the year closes, most options disappear. If you want a structured way to see which of these apply to you and which ones you might be missing, go ahead and explore that at KeepMost.com. The objective is straightforward: correct execution before the deadline. Hopefully you enjoyed this video. My name is Karan. Go ahead and give this video a like so more people see it. Subscribe to the channel for more information that helps you save on taxes and increase your wealth. I'll see you in the next video. Take care.